Hello Accounting 101 students. In this video, we're going to be going over Chapter 6, question number 6, which goes over the inventory valuation methods. So in this problem, there's a couple of things that we're going to be doing. First, we're given some information or data about a company. So we have the dates of different transactions that have happened during the month. We have the description of each of these transactions, and each of these transactions relate to purchasing inventory or selling inventory, and of course we need to consider the beginning inventory as well. So for each of these, we're given the number of units and the cost or the selling price, depending on what's occurring in the transaction, and we're going to go ahead and compute the weighted average cost. And then we need to know the Lifo and FIFO and average cost, ending inventory, and cost of goods sold. And we're also going to be computing the gross profit as well as the gross profit rate. So those are the main things that we're going to be doing in this question. So because we're going to be using this data quite a bit, I went ahead and I prepped us by typing in the information over to the right side. That way you have it all throughout this problem. So the first thing that we're going to do is compute the weighted average cost per unit. So we want to know what is the average cost. So we're going to start off by computing the cost of goods available for sale. And to compute the cost of goods available for sale, we need to go ahead and start off with our beginning inventory, and then we're going to add all of the purchases that have been made throughout this accounting period. So one thing that you're going to notice is that this is the example when a company has a periodic inventory system. For a perpetual inventory system, you would keep track of your inventory every time you had a purchase or a sale. But in this particular example, we're going to be using the periodic system. So we're going to take from our data the beginning inventory, and all we really need to do here is take the number of units times the unit cost to get to your total cost. Then you're going to take each of your purchases, and you're going to take the number of units that are being purchased times the unit cost. So we have these three purchases that we need to account for. And if you're doing the math, you're just going to take the units times the unit cost to get to your total cost. And you're going to do that for each and every line item. So for example, the beginning inventory is 56 units times $23 equals 1288. And you're going to do that for every purchase that the company has made. And the goal here under the periodic system is to really understand how many units were available for sale during the entire period of time, because we're using the periodic method here, and what is the total cost of all of those units. And this is an important figure. I recommend always writing this down for every problem that you do. And the next thing that you're going to be doing is adding up the total units, so that way you know your total units available for sale. During the period equals 353 units. And the total cost of goods available for sale. A lot of times I abbreviate that as COGAS. So COGAS, because it's a lot of words to write down as you continue to work through these type of problems. The total cost is $9,022. So if you want to compute the weighted average cost, you're going to take your total cost and divide it by the total units. And the reason why you're computing a weighted average cost is because in the earlier months, right? So the prior months, you were able to purchase your inventory at a lower unit cost. But as time goes on, it seems like the unit cost for this product seems to be rising. We're not able to purchase it as cheaply as we used to. So when we make these large purchases, we actually paid more compared to the earlier purchases. So that's one of the reasons why we have to consider the weighted average cost per unit in order to consider the price differences. So as I've mentioned, you're going to take the $9,022 and divide it by $3.53. So your average cost per unit is about $25.56, which seems to be pretty much in line with the cost when you look at these purchases. You're in that $25 range for most of these purchases. The next thing that we want to do is compute the ending inventory, cost of goods sold, and gross profit under each of these three methods. So one of the things that you might realize is that sometimes in your problem, you need to determine the number of units that were sold. And that's one of the reasons why I started off our problem with the total units available for sale. That's one of the things that I note down. So that way we can figure out how many units are remaining in ending inventory. So sometimes you have to do a little bit of work in your problem to determine how many units are in your ending inventory. So I'm going to make this font a little bit bigger. That way it's easier to see. Okay. So our total units available for sale, the units that we had in our beginning inventory, plus all of our purchase was 353 units. Then, looking at the information in our problem, we can see that we have sold 34 units, or $34 of product at 90 units. So what I'm really looking at is the 90 units. This sale was 55 units at $39. And the last sale was 113 units at $39. So the main thing that you want to pay attention to here is the units, because you want to determine the units in the ending inventory. So we're going to take the three numbers from our sales and just add that up. And you can see that that happens in this problem right here, where we've added up the 90 units, the 55 units, and the 113 units. That equals to 258 units sold out of the 353. So that means that our remaining units is going to be 95 units. So that's how many units are going to be sitting in our ending inventory. All right. So now we're going to go into our three methods. We have LIFO, FIFO, and average cost. So I'm going to start off with our average cost method because we've already done some of this work. So for our average cost method, we're going to take the number of units in our ending inventory, which is going to be 95 units. And we're going to multiply that by our average cost per unit, which we determined earlier in this problem. So if I scroll back up, you can see that I had $25.56 almost. And remember, you want to use the decimal places that Wiley recommends, so 25.558. right? And then all you really have to do is multiply that out for the ending inventory. Then for your cost of goods sold, this is actually going to be kind of easy. If you know that you sold 258 units, you're going to multiply that by the same cost. So that's how you're going to answer that question. And then for the gross profit, you're going to take each of these units, multiply that by the unit cost, and that will equal to your total sales. So once you know what your total sales are, you can subtract out your cost of goods sold to get to your total profit. So that's just going to be your revenue minus your cost of goods sold. The next method that we're going to go over is FIFO, and FIFO means first in, first out. So for FIFO, what we're going to look at is looking at our ending inventory. So our ending inventory is going to be this inventory that we just purchased. It's still going to remain there. So we're going to take 67 times the 28 cost. And I'm going to figure out, well, how many more units do I need to get from that second most recent purchase in order to get to 95? So this amount right here, this 28, you're going to calculate by taking the difference between 95 and the 67. That's how you're going to determine that amount of units. Okay? And then, of course, you just multiply it out. For your cost of goods sold, you're going to take the cost of goods available for sale minus the ending inventory equals your cost of goods sold. And for the gross profit, you take your sales revenue minus this cost of goods sold equals your gross profit. The next method we're going to be talking about is our Lifo method, which means last in, first out. So that means that this inventory that I just purchased is the inventory that I'm going to be selling to my customers. Okay? And what happens with Lifo is that your old inventory still remains. So I'm going to take my old inventory, 56 times 23. Then I'm going to look at my second most recent purchase. And once again, I want to look at this 95 units. And the way how I'm going to get this 39 units sitting in my ending inventory is I'm just going to calculate the difference. I'm going to take 95 minus 56. That gives me 39 units. And once you know the number of units, you multiply it out, and then you get your dollar amount. And then your cost of goods sold will be your difference between the cost of goods available for sale minus this ending inventory equals cost of goods sold. And then you take your sales revenue minus cost of goods sold equals your gross profit. The last part of this problem is computing the gross profit rate under each of these scenarios. So you'll remember that the gross profit rate is going to be your gross profit divided by the net sales. So using the information from this problem, you're going to take your gross profit that you calculated earlier divided by the net sales for each of these. And one of the things that you're going to notice is that the trend is that our price of the product is increasing. Okay, so that means that our gross profit is going to be highest under FIFO and lowest under Lifo. And this really speaks to the prior comparisons, right? When we compared these three methods and we notice that under FIFO, we have the highest ending inventory and the lowest cost of goods sold and the highest gross profit. And this is the trend when prices are increasing. So, when prices are declining, it'll be